if you remember last class, we actually introduced two really important concepts for the valuation analysis. Was time value of money in the form of inflation, and we also checked depreciation and what depreciation means for investment, that is capex investment. And we saw that depreciation and amortization are recognition of loss of value for assets and investment on assets that a company has to recover and show in their books, and that is income statement and balance sheet. And we saw that depreciation for the income statement is shown as pure depreciation, that is an expense, and in the balance sheet you should show depreciation as an accumulative value. So the last thing we need to see today to just close the depreciation subject, it's the different types of depreciation. Now, there are more types of depreciation depreciation and amortization that you can find in more accounting analysis and more accounting-ish classes. But now I will just review with you the three main depreciation methods. So the first one is straight line. That's the method we use here for the case, and that's the method you will be using to present your information and your financial analysis. Other depreciation amortization method is accelerated depreciation, and then you have units of production depreciation. These are the most commonly used methods. There are other methods, yes, but these are the three most commonly used. So those are the ones that you actually should keep in mind in case you need to do capex analysis and depreciation. So a straight line depreciation. What is a straight line depreciation? Well, for straight line depreciation, you recognize the same amount of value loss of the asset during time, just taking in consideration the asset's useful life. The formula is really simple. It's just the purchase value of the asset, okay, minus the cost of salvage value and divided by the useful life of the asset. You divide that, you get the same amount of depreciation of value loss during the time of usage of the asset. And that's what you recognize inside the income statement. That's how you will look it. That's how you will see the depreciation and the value loss during time. It's you start with the asset value, and then you have a recognition, equal recognition of loss of value during time. And in this example, that you can see on the graph, the useful value of the asset was 9 years. So during 9 years, you have the same loss of value for each period. Of course, if you want to make this loss of value a monthly value, you just divide it by 12, and then you have the 12th period depreciation expense value. And it's pretty straightforward, just the same value, the same user's life, and you are just recognizing the loss of value at the same rate every year. So a straight line depreciation, that is a straight line depreciation. Do you have any questions? No? Okay. Moving forward, so that's straight line depreciation. Next type of depreciation is accelerated depreciation. This is a depreciation expense that is mostly used for tax analysis purposes. Actually, if you use accelerated depreciation, then you need to change it when you are presenting your income statement, as it is not an accepted type of depreciation by the NIF, because accelerated depreciation doesn't show you a true link between asset value loss and income recognition in the income statement. So what is accelerated depreciation? Basically, is that you recognize the most of the asset, or sometimes all the asset, as an expense in one single period, or as accelerated periods. What you are looking here is to create losses for you to pay a lower tax rate. So the formula is 100% divided on the useful life of the asset times years of accelerated depreciation and times beginning period of the book value. That is, you will depreciate a percentage accelerated of the book value of the assets. For example, if you multiply this by 1, that means that you have 1 year of accelerated depreciation. That means that you will recognize the loss of the value of the asset completely 1 year. That means that if you have an asset worth 100,000 million pesos, you will recognize the 100,000 million pesos as an expense in the same year that you buy the asset. And that sounds a little bit sketchy, but it happens. Actually, from 2000 From 2014 to 2017, during Enrique Peña Nieto's tenure as president, the SAT allowed accelerated depreciation recognition of assets for 1 year for most of assets in a company. So a lot of companies use a big, huge transnational corporations apply accelerated depreciation in their assets, and they are still carrying forward losses generated in that period. So when you have accelerated depreciation in your hands, and you can use it as a business, and you can use it for reducing cash flows, the general rule is you should use it. You should, if the law allows it, you should use accelerated depreciation. Anyway, how you see accelerated depreciation inside your income statement? Well, you will see the same value of the asset, but now, and just compare this with the straight line depreciation that you see, like the same value being deducted from your asset's life, like the same value every year during the useful life of the asset. Here, what you see is that you see double of that amount. You see, and then you are accumulating the depreciation faster. Okay, and even though you still have 9 years to depreciate the assets, just notice how the first years you have a higher value of depreciation. That is a higher impact on your tax bill. So accelerated depreciation, sorry, it's a way for you to recognize the loss of value faster. And the main goal of this is just to impact your tax bill. That is accelerated depreciation. You guys have a question?
No, teacher.
No? Okay. So next type of depreciation, as the last type of depreciation, is units of production depreciation. This one is used mostly in factories, and again, it is not. This one is not allowed, and this is this will be the contrary of accelerated depreciation for financial norms, because this type of depreciation, it's allowed in the financial norms, but it's not allowed in tax codes. So if you have units of production depreciation for financial presentation purposes, you need to change it for tax code purposes. And what is units of production depreciation? Well, here you recognize the loss of the value of the assets during the useful times, but it's related as a function of the units of production of the assets. So it's most for factory machinery. What you do is you take the units of produce on a year and you divide it by the lifetime units of production, and that is the rate you will be recognizing the loss of value during time. So basically what that is that if you buy a machine and you expect to take a certain amount of units of production out of the machine during a certain amount of time, the time doesn't matter. I mean, the useful life doesn't matter here, because it doesn't matter if the machine is supposed to last 10 years or 5 years. What it matters is the amount of units the machine will be able to produce. And it's just a percentage of that production that you take each year. And you see in the graph, this will be more like a crazy tendency, depreciation recognition during the time, because it's not going to be the same production that you have here, than in later years. Maybe in these first fiscal years, you have a low production of units because you are starting the business and you are expecting to invest a high capex for the asset to generate units in the future. And then when you actually start generating units, the depreciation accelerates, and then again it reduces. Why? Because because you are reducing the amount of units produced as the asset devalues during time. So that's the units of production depreciation. It's related with the production of units of a machinery. And again, as I told you, I mean, the keynotes here is that this type of depreciation, it's allowed in financial statement analysis and financial statement reporting standards, but is not allowed in tax code. At least in the US and Mexican tax code is not allowed. So when you present your taxes, you need to take back the depreciation and then recalculate it for the year as one of the allowed depreciation analysis, maybe accelerated or straight line. Most of the depreciation allowed in tax codes actually is a straight line depreciation. So if you learn that one, you are set to go. Those are the three types of depreciation. And do you have any questions about unit production depreciation? No? Okay. So that's units of production. Depreciation takes us now to more, well, all the depreciation analysis takes us to something that is called CapEx. CapEx is defined as capital expenditure, and it's the, I mean, it's defined as the payment of goods or services recorded or capitalized on balance sheet instead of expense in the income statement. And that's the technical way of defining it. But CapEx is the investment you do on assets, expecting those assets to generate future cash flow. Remember what I told you at the first class, the main goal of a business for the financial perspective is to generate cash flows. So each time that you do an investment on assets, it should be with the expectation of generating future cash flow from those assets. If you buy a machine, it's because you expect to increase your production, therefore increasing your sales, and in the long term, increasing your cash flow and your cash input for the business. So CapEx is capital expenditure and it's investment on assets. What is important because, well, CapEx is not only buying new assets, it's investment on assets. So it could be buying new assets or investing in existing assets to keep their useful life longer, and then also generate future cash flow. For the general rule, if an item has a useful value of less than a year, it should not be considered as capex. It should be considered as an expense. And if it has a higher value, I mean a higher useful life than a year, then you can consider it as a capex. Remember, that's the goal for identifying capex. I mean, that's the trick for identifying capex. If it lasted more than a year, if you are expecting it to last more than a year, then it's an investment on assets. It's capex, and you can depreciate it, and you apply one of the formulas of depreciation I just showed you. If it is not, then it's an expense, and you recognize it fully on the income statement as an expense. The formula for calculating assets is just property, plant, and equipment change. Remember, design means change. Property, plant, and equipment, it's the value of all the assets without the depreciation. And you can see it here because it tells you, well, it's a change between property, plant, and equipment during years, and then you add up the current depreciation. And this is something that happened to you guys in the cash flow analysis, because you only saw the current depreciation change. I mean, I'm sorry, you saw the change on assets. I'm guessing most of you did that. You saw this change of assets, and you stayed with the idea that we said the previous two classes, that most of the time in the cash flow analysis, when you see a change on assets, total fixed assets, I'm sorry, what you are seeing is the depreciation change. And that is true for most of the periods. But when you do a capex investment, then you have a higher change on assets, and that is property, plant, and equipment change, and that is actually an investment on capex. There is an investment on capex on the case, and in most cases, not only in this business problem case scenario, but in most cases in a business, you will have an investment on assets, as companies are expecting to keep generating cash flow, so they need to keep maintaining their assets. So they keep investing on the assets, buying new assets with the expectation of at least keeping the cash flow of the business. Of course, in the long run, we all want cash flow to increase. So the investment on assets should be to increase that. Anyway, what you can get out of capex? Well, you can do capex ratio. I'm sorry, and the capex ratio, the most commonly used is capex. Is cash flow from operation over capex, and well, that tells you how much of your capex or your investment on assets can be financed with cash flow generated by the business. If that number is higher than one, well, it means that the company has enough cash flow to keep investing on its assets. If it's lower than one, it means that the company does not have enough money to invest on its assets. And just think about that for a second. What would it mean if a company didn't have enough cash on hand to pay for its assets? Well, it could mean that the company is not well capitalized, and it doesn't have the necessary money to keep investing on the company and growing. That will be that's what would mean that you have if you had a capex ratio lower than one. So of course you are expected. I mean, you will want to invest in companies which capex ratio is higher than one, because that will mean that they are generating enough cash to reinvest on the assets company and actually generate cash flows. Okay, so last thing we have to do is modify your Excel spreadsheet to include depreciation in the model. I mean, you already did that. I mean, you already modified your Excel spreadsheet by just copying the value of cash flow. The value of the depreciation I gave you when I shared with you my file. But what I want you to do now is for you to calculate the depreciation and then add it. You should add it to your cash flow, because that depreciation will change as you analyze the business and compare it to the different options you have. So what we are going to do now is we are going to go to breakout rooms. You have 10 minutes now to do this, and the idea for you is, again, go to the breakout room. One of you please share your screen and your file, and then in the file change or try to change the depreciation. Then we will come back to the main room and we will review one of your results, or if you couldn't answer that, we will answer all together the question to change the Excel. Okay, so let's go to the rooms. Before we go to the rooms, do you have any questions regarding depreciation? No? Okay. So let's go. Hello guys, good morning. Remember, one of you has to share his or her screen.
Good morning.
Good morning. So I'm going to break out room number 2 to see if they are sharing already. One of you has to share. Please try and do so you can all learn together as a team. Hello guys, good morning. One of you has to share his or her screen, remember.
Okay.
Beautiful woman, one of you has to share her screen. So please try and do so you can practice depreciation.
Okay.
Hello guys, remember, one of you has to share her or his screen to do the activity. Hello guys, remember, one of you has to share his or her screen for the activity.
Teacher, I was just wondering, I didn't understand what specific asset are we supposed to add the depreciation to?
Well, depreciation is already calculated as a fixed value in the income statement, and what you did was just to copy the value and then just cross it to all the periods. So what I want you to do is to calculate that value. The value I gave you, 26,000 or 28, something like that, just calculate it. You have the assets there, they are on the balance sheet. You have the value of the useful life, it's on the case. I think it's 10 years. So just calculate that number and change it as a formula.
Okay. I understand.
That's what I want you to do. Just change the number I gave you with a formula, and you now have the information to do that.
Okay.
En el Capex no también.
Yo no lo he cambiado.
Faltan de los de 2 meses, no lo cambié. Ya, no sé si sea el que yo les mandé al grupo. Ay, güey.
Hay que cambiarlo, ¿no? Primero y después ya hacemos lo del... Es que, bueno, no sé, yo le quería preguntar algo al profe, pero...
¿Qué me quieres preguntar, Andrea?
Es que, o sea, no entendí. Según yo, cuando pagas tu deuda, que son los 25,000 pesos que paga cada mes, o sea, se pone en liabilities paid, ¿no? Y, o sea, el cambio cuando inviertes en tus assets, se pone como...
that word is wrong. It's bought. Yeah, but yes, you put it there. You put it as assets bought.
Okay.
Now go up, please. I don't know if you did it right. It's actually really easy to see that. I mean, go up to see the capex. It's just a change on assets. So go up, and you can see it here. A little bit higher, please. A bit more. More. I mean, show me the assets. That's what I want. Oh, okay, look. So you have 1,500,000, 1,507,000. What is the number called? 750,000. Okay, so you have those, and you can see, I mean, period number 1, period number 2, they are the same values, you see? And then on period, I don't know what this is, on column K, you can see a change on assets. You see it? Go to the asset. Remember, property, plant, and equipment. That's what you are trying to analyze. And property, plant, and
Sí.
equipment are the assets, like the value of the assets. And you can see 1 million, 1,500,000, 750. You see them?
Sí.
And then you see how it changes, right? On column K, it goes from 750 to 850. And then it goes again up to 950. What is that?
That you buy assets.
Yeah, you are investing on CapEx. That is CapEx investment. And CapEx investment affects the cash flow. So you have to go down and subtract 100,000 from your cash flow because you are
Okay.
buying. So your assets bought, it's 100,000 and 100,000.
Just on those ones?
Well, analyze it further, and if you see any other change, then you put it.
Okay.
Now, what I want you to do for the activity is to actually recalculate depreciation. So check depreciation. That's 27,000. Where did you get that from?
I subtracted this one minus this one.
Okay. Now, what I want you to do is actually go up,
Mm-hmm.
and you can see that number there on the depreciation expense. You see it? 27,000. Oh, 27,000 there.
Yes.
Okay, and that's a fixed number. I want you to calculate that. Mhm.
Okay, with the formula?
With a formula, yeah. That's a straight line depreciation.
Okay.
Hello, guys.
Hi, teacher. Hi,
Where is
teacher.
the screen?
Mariana is the only one that can share her screen, and she wants to share it.
Do you want to share your screen, Mariana?
Well, it's because I think that my exercise is not that good as, for example, Sherry's exercise, and she wanted to share her screen so we can do it perfectly.
Well, just think about this. You have to correct your homework for the next assignment. So if you share it now, you can actually advance on your homework.
Okay.
Voy.
Okay, perfect. So what I want you to do is to calculate. Look, that change in operating activities, that 27,000 you have on depreciation. You see it? Okay, you have it as a fixed number. Where that 27,000 comes from?
Well, I copied and pasted from the first. Oh, I really don't remember. I think it's a depreciation or something.
Okay, so, well, it is a depreciation. You think correctly. So put it as a formula.
But like I have to do the formula of straight line depreciation in this.
No, you have to do it in the income statement. You are correct. Here you don't do it. Here you just indicate it. So here actually you will have to put equals, and then you have to direct it, link it to the cell of depreciation. Where do you have depreciation expense? Where do you find
I don't
it?
remember.
Citlali, Anna, Shelling.
Oh, here in the income statement?
Yes, in the income statement. That's where you find depreciation. And as you can see here, it's just a value. So what I want you to do is to change that for a formula, because it actually changes when you do an investment on CapEx.
So here is where I have to put the straight line depreciation formula.
Yeah.
Okay.
Okay, I think, wait, I'm not seeing your screen anymore because I clicked something. Now I see it. Okay, no. Okay, now, yes, you have to put the result of the depreciation straight line formula. You can put the formula here if you want. Just bear in mind that if you change it later, I mean, because we will do that, we will change depreciation when we move further on the analysis. Maybe you will have to change your file. And guys, girls, remember always to have formulas inside your analysis, your projection. Why? Because if you change the projection as you move further on the analysis, not just on this class, but also on other classes, it is easier to change the analysis if you have everything as formulas. Compare as if you have fixed values like this, because now, Mariana, you will have to change every single value manually, you see? Because you did it as a fixed value.
Okay.
Okay. So you have any questions?
No.
No? Okay, change it, please.
Yes.
What you guys are doing here?
Good. We just started screen sharing, but we were wondering if we take we calculated depreciation, but only for the like para el local, no?
No, you have to calculate it for the full, all the property, plant, and equipment.
Okay.
Is this your screen, Aldrich?
Nope.
It's Frida's, right? Because it says Frida Lucero at the top.
Yes.
Yeah. Okay. So actually, Frida was one of the homeworks that was able to identify capex investment. Could you please show that to your teammates, classmates, Frida?
Capex?
Capex investment.
I think that I wasn't teacher because you told me that it was one.
No, you did.
No,
Yeah.
where?
Your capex investment. What is capex investment? I just told you what is capex investment. It's investment on assets. So did you see any change on your assets for your cash flow?
What, teacher? Sorry?
Did you see any assets change, any assets investment on your cash flow when you were doing your cash flow? I'm starting to think that you just copied someone's homework.
No, yes, but I'm not really getting what you're telling me.
No? You aren't understanding me because of my English, or you aren't understanding the question?
I'm not understanding the question.
Okay. So show me your cash flow and then explain to me and to all of us how the cash flow for September 2006 and October, September and October 2006. Explain us those numbers.
This one's?
Mm-hmm.
It
Tell
was
us, what is
there
that?
a change in an investment that was done, I think so, and I think it was because of these ones, if I remember. There was a change in these two numbers, and they have variation of 100,000.
And technically, how is that called? That change on the assets? Guys, some help. You all have to correct this for your homework because only Frida got it right.
That part?
Yeah, I mean, it was a comment I did in most of your homework. So why did Frida? I mean, she's correct she saw that change and she put it here. With that, what is that called? And why you should put it in your cash flows?
Well, like that is the outflow of money to invest in your assets, right?
And what is that called, Aldrich?
Capex.
That's capex. You see, Frida?
Yes, sorry.
So the change on assets that you have as an investment on assets, it's called capex, and you should put, I mean, not should, you have to put capex inside your cash flow. And if you see Frida, she actually put it, I mean, well, you put it here on investment activities, you should actually have put it on assets bought. That word is incorrectly written, so also change it if you will. So that's actually goes a line down. Yep, exactly.
Okay.
There. And you can see that Frida had it correctly because if Frida were to compare her cash at the end of the period, for example, there, it's 221,000 pesos, and then you go up, and on cash on hand, you have the same number. You see?
Teacher, I actually have the question because, for example, in the part that it starts to variate, it's from this period.
And what is that? Why is that?
Of the depreciation, I think so.
It's because of the depreciation, exactly, Frida. That is why I'm asking you to recalculate depreciation.
But you have to recalculate it in the income or in the balance or in the cash flow or both.
You have to recalculate it in the income statement because it is correct on the balance sheet.
Here.
That 27,000, why it changes? Why do you think it changes? Why you guys think it changes? All of you guys, Aldrich, Andres,
Because it's
Anna.
like second year, like it's not yeah, like you just need to add up because a year has passed and like I don't know how to explain it, but the value
Something
has
changed.
decreased.
You are correct in what you are thinking. You are thinking that, well, maybe something changed between years that made that change. So what changed? What changed at the end of the year?
The
Almost
value
at
of the
the
money.
almost
The
at the end of
salvage
the
value.
year. No. Almost at the end of the year, something changes, and we just saw it.
The I remember. I think it's the taxes rate or something.
No, what it changed almost at the end of the year. Also, you have to check if you are adding inflation correct, but I am pretty sure that the main difference it's the depreciation. Depreciation is linked to the value of the assets, and then you have in October and September you have a change in value of the assets, so you also need to recognize the change in depreciation.
It's here. So we have to subtract.
But you have to calculate depreciation.
Yeah. Okay. But
See?
okay. So, but what formula do we have to use, or
Well, what?
formula do we have to use?
A straight line depreciation.
Okay.
You need to use straight line depreciation, and if you read the case, it tells you what is the useful lifetime value of the assets. I think it's 10 years.
And we have to use, what do we have to use as the purchase value? Like the one Frida is.
The purchasing value is the value of the property, plant, and equipment on the balance sheet. A salvage value, you don't have salvage value. In the case, it tells you it's 0.
Okay.
I think we just are a bit over the 10 minutes, so I will just check another breakout room, and we will move back to the main session. So how you guys did?
I think I found the data in the case, but I'm not sure if I have a little doubt here.
Well, share your screen.
Yes. Can you see it?
Yes.
All right. So here in the income statement is the depreciation expenses.
Yeah.
Amounting to 27,083 pesos with 33 cents. Then I found the data in the case which said the useful life of depreciation for the forecasted expenses was 10 years, straight line method, and a 0 peso rescue value.
Yeah.
So when you multiply that by 10, well, I think I might have actually done it wrong because I think it was monthly.
Yeah, it's 12.
Is it monthly or yearly?
Well, it's yearly, so you want to see the full value, it will be 120 because it's 10 years, you see? How many months are in a year? 12. 10 years, 120 months.
Okay. Oh, yeah, that's true.
But what I want you to, you are correct, but you are trying like to calculate it from the depreciation. What I want you to find is the depreciation value. So add up all your assets first.
All right.
So do it.
Yes.
No, I will help you because you are in the right track. So just add up all your assets, your property, plant, and equipment.
It said the brewery was not to be taken into account, right?
For the valuation, for the business,
yes.
you have to.
The valuation.
You will change that, of course, because you already found out that for the valuation, you need to take that out. But for right now, you just add it up.
All right.
Because this is income statement.
So total assets, they're here.
No, property, plant, and equipment. If you do that, you are already taking into consideration the depreciation. You see, you're adding up depreciation there.
Okay. Sure. Okay, I understand. So I add all the assets of that category.
So how much is that? Okay.
3,250,000.
Perfect. So that's what? That's the purchasing value of the assets, you see?
Yes.
Now I want you to calculate the depreciation. How do you do that? Well, the
With
formula
this payment,
said, you remember the formula? The formula said purchasing value minus
yes.
salvage value divided on useful life. So
Okay.
what is the salvage value? Do it down there.
0.
So how much you need to subtract from that?
Basically divided by multiplied by 10.
Multiplied?
No, sorry, divided by 10.
Let me see it. Why 10? Why 10, Alejandro?
Because the case says the useful life is 10 years.
Exactly. Yeah, you are correct.
So if you're basically
So that's what? That's yearly depreciation, right?
Yes.
So you need yearly depreciation or you need monthly?
Monthly.
So you need to do that with that number.
Oh, okay. So I can just.
Yeah. And there you have it. You see it?
Ah, nice. All right.
So that's the number you need to put there. Now, bear in mind that assets do change. And also here, I don't know why you did this. I mean, you are showing on the line number 97, you are showing the cash generated from financing activities, but only for column F. And you should be showing it for all the columns.
Sorry, I think my internet's bad or something because I didn't hear.
Look at line F. I mean, like 97, column F,
Yes.
you are showing the effect of change in liabilities, but you only show it for one period. You need to show it for all the periods.
Yeah, that's true. That's wrong.
And also go up and analyze the assets. I want to ask you a question, Fernando. Alejandro, I'm sorry. Do you see a change on investment on assets? On the period of the
So
valuation?
CapEx?
Yeah, do you see CapEx on the assets? Assets are on the balance sheet. Go look in all the periods. Do you see a change on assets?
Oh, there's a change here.
Oh, okay. So what that is?
That's, I think, the remodeling, because in the case
exactly.
it says
and the
there's a
remodeling
remodeling which is forecasted to cost between 100,000 and 200,000, and it's to be done every
in
4 or 5
payments.
years or so. I think, depending on. That's due to like general custom for bar ownership in Guadalajara.
But what that is? What is that called? You as a financial analyst, how do you call that?
I don't know.
You said it just a few minutes ago. That's capex.
Yeah. Okay. That's capital. Yes.
So where do you put capital expense?
Assets, right?
Yes, exactly. Investment on assets. Yeah, exactly. That's right. So you have to put it somewhere. Where will you put it on the cash flow? Because you are taking money out of the company and then you are buying assets with it. So where do you put it?
Here in investing activities.
Yes. Where?
Change into assets spot. And so this, I think it's right here. So from here, it goes. So 100,000.
100,000 one month and 100,000 another
yes.
month. Yep. Change that for your next homework.
Okay.
Okay, guys. So we are gonna go to the main session now. Remember, you need to calculate depreciation for all the periods. Also remember that if assets change due to capex investment, then you also need to change your depreciation. Okay.
Yes. Okay.
Good job, Alejandro. Okay. Hello, guys. So I think all of you guys actually, well, in most of the rooms you show me an advance, and I want to know if one of you wants to share or has a question and wants us all of us to see it. There's Excel spreadsheets, so we can help you check a question if you have one, or maybe if you want to, or if you have a question and you want us to check. No?
Can you show me like exactly what do we have to depreciate like in the case? Because I couldn't find it.
Yeah, Alejandro, could you share your screen? Because you actually did it right. And you have a formula and everything. Do you mind?
Yes.
Let me
Just
make
wait a
you,
moment.
yeah, let's just make you, I will make you co-host so you can share.
All right. Thank you.
More. Yes. Okay, go ahead, please. So first of all, you need to recalculate depreciation. Could you please tell us how you calculated depreciation, Alejandro?
Yes. So first I calculated the, well, seeing as how the monthly value here was, income statement, depreciation expense was 27,083 pesos and 33 cents. And so I determined that firstly I added all the assets together. So the property, plant, and equipment, that is only the long-term assets, which are the ones to be depreciated over time. And we also have a formula here for accumulated depreciation. But since we added up all these assets here below, we get the number of 3,250,000 pesos.
Exactly.
Now, when we know from the case that the salvage value is 0, so we do not have to add anything to this value.
Subtract. Yes.
Basically, we plug in the values for in the formula of depreciation and just clear for the depreciation value. And so when we multiply this by 120, given that we want a monthly value and we have a useful life of 10 years determined by the case, we get the value of 27,083 pesos and 33 cents, which matches the depreciation expense we have here in our income statement.
Yep. That's what you have to do, Andrea. You have any questions?
No.
No? Do you, so all of you understood what Alejandro explained? I mean, I think he explained it brilliantly because he did the formula, he put the values there, and it's really easy to understand. So all of you need to change that, because if you don't do that, then your cash flow won't match your bank statement, and you won't have a correct net present value analysis.
Teacher, are you going to be uploading the presentations from this class?
Yes, of course. Yes, I didn't do it last class because we haven't finished seeing depreciation and all of that, but I'll do it.
Thank you.
Okay. So thank you, Alejandro.
Yes, thank you, teacher.
Okay, so let's continue with the class. Remember, all of you need to change that because, well, you will see why now. If you don't do that, then something is going to be wrong when you do the analysis. Okay, so that's what you need to do. Please change that for you guys to have a correct analysis. And then, now, what is the next thing we need to see? Well, now we're gonna see cash flow, free cash flow. What is the difference between free cash flow and cash flow? Well, it's a little bit of change on the calculation, and mostly it's because of the usage of that analysis for corporate finance analysis. And that is that free cash flow, it's the money generated by the company expected to be used for operations only. So you take out interest expense and tax shield expense. So, and as I told you at the beginning, the reason we are not adding interest expense on our income statement is because you will have to calculate these two. And it's just a pain because tax rate changes between years. So you will get a bit confused. So don't worry, we don't have this. All you need to have is cash flow from operations and capital expenditure. So basically your cash flow statement, if you did it correctly, is your free cash flow. Okay?
Sorry, can I say something, Christopher?
Yes, Felipe.
Hello, everybody. Good morning. And I want to clarify in order to avoid confusions, because you can say, why do we have two cash flows or two different cash flow statements or methods? No, it is actually the same idea. I mean, the difference is that the financial statement of the cash flow, we can think that is more complete, okay? Because you can see the operating cash flow, the investment cash flow, the financing cash flow. But for valuation purposes, actually, we don't need everything, okay? We can focus only in the operating cash flow and a few more things, like CapEx, for example. So for valuation purposes, we can define free cash flow in a more simplified way, okay? So you can understand this way. This is a simplified way to focus on operating cash flow, okay? And that is the cash flow that we need in for valuation. And this class is about project valuation, okay? But it is also important that you know that this comes from this financial statement, which is more complete, and it can help you to do some other things, okay?
Yeah. Thank you, Felipe. Exactly, that's exactly right. Remember, all the information generated on inside the company for financial purposes, it's changing. It changes depending on the financial, on the analysis you are doing, on the objective of the information. And just as Felipe was saying, the cash flow statement has a lot of things inside. When you see a bigger cash flow, because of course of cash flow is simplified, intending to have an easy, I mean, you will not see difference between free cash flow and cash flow statement in our case analysis, because we simplified for you guys to don't have any trouble. But the thing is that you need to have in mind that free cash flow and cash flow statement are not the same thing, and you need to subtract basically these two. And I will show you more formulas for you guys, because as Felipe just said, it's just a simplified form of cash flow. You can have it, I mean, you can find the same result using different methods. Other method formula, it's actually it's more like the formula for the complete cash flow statement. And again, the difference is that you need to add the interest expense impact on the cash flow. So that's another thing, but this is another formula. You take the information from the income statement and you add and subtract information as you go to find the free cash flow. Other formula is this one, and this one is one of the most commonly used, and it's one that you go from EBITDA, from the EBIT, I'm sorry, and then you subtract the tax shield. This one here is called the tax shield. So in case you are wondering what is tax shield, it's the reduction on the interest expense by reduction on the tax bill at the end of the period, because interest expense are a deduction for the business. So that actually reduces your tax bill. So that's why you have to put it here. Of course, you add non-cash expenses, and again, the analysis is depreciation and amortization, changing the liabilities, that is on debt, and again, CapEx. You always need to add CapEx. Another formula, it's again from the income, interest expense, all the tax sheet now it's separated from here, it's not in the EBIT, and again, non-cash, and changes in working capital and CapEx. Those are like the main ways to calculate free cash flow. We will be using this one, the first one I show you, because it's the easiest when you have your cash flow statement. When you don't have your cash flow statement, then you need to go for one of these. But as we already did all the trouble of building our cash flow statement, we can use this one. And as we don't have interest expense, it's actually a lot easier, because our cash flow for this case will be the same as our free cash flow. So if you have your cash flow statement correctly formulated, then you already have your cash flow. your free cash flow. And then just let's see why it's important to have a free cash flow analysis. And see this example here, you have your sales, you have your net income, and then you have your free cash flow. And this is just an imaginary company where it's the same, all the values of the company, and you have to just sold 98,000 pesos this year, and then you have a net income of 10,000 pesos, and you have a free cash flow lower than your net income, and you have lower cash flow than your net income each period, and then you have a huge difference on your net cash flow, on your free cash flow, I'm sorry, and your net income here. So my question to you guys is, what would you conclude about the companies that show you this difference between cash flows and net income? So what do you guys think is the difference? Like, here you are, I mean, you are selling the same, right? But here you are only reporting 8,000 pesos over 10,000 net income. And the real problem is in years 2018 and 2019, where you have a negative cash flow.
They haven't collected the money from the sales.
That could be a reason, exactly, Andrea. Maybe they didn't collect the money from the sales. What other analysis you think it might come? Well, let me tell you 3 possible analyses you could gather from this. The first one will be investing in growth. Maybe the company is investing in CapEx. Maybe here you have negative cash flows because the company is investing in assets. So you will need to go to your balance sheet and see if that is correct. Okay, so that will actually be a good thing for the company, because it means, again, remember, CapEx investment, the objective of CapEx investment is to get net future cash flow. So you have that there. Maybe it means that the company, a company board, it's actually investing on assets for the company to generate future cash flow. That could be a reason. Other reason maybe is that they have a stockpiling inventory. Remember, inventory is part of something that is called cash conversion cycle. So maybe you have a lot of sales, but you have inventory, and here inventory accumulation. And here I'm giving you a real life example. I mean, maybe all of you didn't know what the UGG boots are. And see this example. This company, for that product, grew the sales by 3% each year. However, the inventory grew more than 26%, which caused free cash flow to fall that year, even though revenue was rising. What this means is that the company was selling a lot of these boots, but then they show an increase on their inventory. All right? So maybe if you see that, it means that you are not moving your inventory as fast as you are expecting, all right? Because maybe the company was expecting to move their sales at twice of 3%, and they just bought a lot of inventory of these boots, and at the end they didn't sell as much boots as they wanted. And this actually happened for 2015 and 2016. So using this information, you as an investment, you will go to your balance sheet and actually compute their cash conversion cycle with their inventories, and then maybe conclude that this is not such a good company, because even though they are selling a lot of boots, they just stockpile inventory because maybe this type of product, these boots, they just stop selling. So that's another analysis. And finally, the brilliant analysis Andrea told us, maybe they have credit problems. Maybe they are selling a lot, but they have problems collecting their sales. And this happens a lot with when you have fluctuations in the company, because you cannot sell enough, so you start giving a lot of discounts, so your sales peak, but you cannot collect the sales. So that also happens. It's a credit problem, and that's correct, Andrea. It was a really, really good analysis. But those are the 3 things you can gather from that: that you have investment in growth, you have stockpiling inventory, or you have problems collecting your sales. Again, cash generated before dividends and financing should not be included inside the free cash flow. Don't worry for the case you don't have it. Why aren't we adding interest expense? Well, because you will see in one analysis that is called net present value analysis, if we happen to have interest expense in the cash flow, then when you discount those cash flows to the net present value, you will be discounting interest expense twice. So that will be another problem for you to worry about. We don't have interest expense on the case, so you don't need to worry about this, but you do need to know that interest expense is not included in the free cash flow, because it will mean for you to deduct it twice when you do a net present value analysis. Again, cash flow is better than cash flow analysis is better than cash flow analysis is better than net income analysis because it shows you a better operational analysis of the business. And it's not a part of the mandatory financial statements, just as Felipe was saying. So if you do a free cash flow analysis, it's for investment purposes analysis. Okay, so last activity of the day will be you guys to go again on the breakout room and fix your cash flow statement. But we already did that. I was checking you guys your cash flow on the projects, and you all have the same error. So I'm gonna tell you so we can move what you need to change. And remember, you need to change this for the next homework, or you will get a bad reviewing homework. So you have your net income. Okay, then you add depreciation. Okay, this will give you operational cash flow. Okay, then from here you add or subtract investing activities. And this will give you your investing cash flow. From here you add or subtract your financing activities. This will give you your financing cash flow. Right? You add this, and then you get your cash flow, right? Of the period. You add your cash flow at the beginning, and then you get your cash flow at the end. Okay, you all guys have this correct, this correct, this correct. Some of you have this correct. Remember, you have 25, I think it's 25,000, correct me if I'm wrong, payments on debt that you are supposed to do every month, to do every month. So you need to add this. Okay, so if you didn't have that, do it. But I think like 90% of the group had this wrong, the investing activities. Investing activities is related to CapEx, all right? Now, in the case...
Teacher, I have a question. So in the investing activities, we only need to put the 100,000 of the 2 months?
Yeah.
That were...
That's it, exactly. You have 2 months and you have 100,000 in 1 month, and then you have another 100,000 in another month.
Okay, so we only need to add it to have it. Oh, okay, well, good. But those 2 months are the only ones that will have that variation?
In this analysis, yes, but the idea for you guys is to, when you do your final project, you will need to recalculate these cash flows for the 3 options that you have as an investment option. That is to sell, to lease, or to keep running with Fernando's father.
Okay.
So remember, you need to change this for this homework, because if you don't have this, then you will have your net income, and I mean, you will have your cash flow wrong, and that will make your all of the analysis wrong. Okay.
Okay.
All of you got that. You all know now what you need to do, right?
Yes.
And also remember, you need to recalculate depreciation, because you just copied the number I gave you, but you need this as a formula, because when you do this investment, depreciation changes. Okay?
Okay.
And depreciation is not affected by inflation. Okay?
Okay.
So remember those 3 things. I will be reviewing those 3 things in your homework. Okay. So by the end of this session, you are supposed to have your inflation rate fixed inside your calculator, inside your fixed expenses except of depreciation. You will have Also, depreciation calculated in both your income statement and your cash flow, and you are expected to have your free cash flow built for your business model. And remember, do use formulas for everything, as you will be changing that when you do your final project analysis. Okay, guys?
Okay.
Okay, so that will be it for the
Teacher,
cash flow.
when are we going to deliver this homework for the next week?
Next week, yeah, I think I put it on Thursday or Wednesday.
Okay.
It's one of those 2 days. I mean, you have plenty of time, guys. And why do you have plenty of time? You may be wondering if you already changed it. Well, it's because what we're going to be seeing today. The next homework, if you are a bit curious, goodbye, Felipe. If you are a bit curious, it's about time value of money. Okay, so these homeworks will be evaluated. I will be reviewing if you got the correct result or not. For the previous 2 homeworks, I didn't, because those were just financial statement analysis. So for the next homeworks, I will be evaluating that you did everything correct. If you didn't, well, you have a minus credit because it was incorrect. Okay. So next part of the class of the course, it's capital budgeting and evaluation models. And the main idea here is that you start learning how you apply evaluation models in an evaluation for you guys to take a business decision based on the ability of a company to generate cash flow. Because remember, the main objective of a company from a financial perspective is its ability to generate cash flows. Nothing wrong wanting to have a company that helps the people and all of that, but you as a financier are supposed to evaluate cash flow generated by the company. Okay? What are the objectives of today? Well, I mean, objectives of these following 2 sessions, well, it's capital budgeting, net present value, internal rate of return, and payback period. I hope we can finish net present value today. If not, don't worry, because the homework will be delivered after next class. So you will have also next class to review that. If we do that, well, great, because you will have all the weekend to work on that. If we don't, then don't worry anyway, because on Tuesday we'll be still reviewing capital budgeting. Okay. So first of all, let's start with what is capital budgeting. Capital budgeting is planning investment on a business, and an investment could be an investment on CapEx or an investment on future expenses. What is that? Examples of that? Well, maybe you need to change, maybe you need to do replacement to continue current operations. That will be an investment on maybe fixing assets. That will also be categorized as CapEx. Replacement for cost reductions. Maybe you are doing an analysis for automatization and you conclude that you need to buy a new machine. And well, that will in the future convert in cost reductions, and a cost reduction on the income statement, and if your sales remain the same, will mean an increase on your cash flow. So that's also a thing you may be doing. Expansion of existing products and markets. Well, you want to increase your sales, so you will be maybe buying a new machine to increase your production, and maybe renting a bigger place for you to put all your machinery and move your factory. That's also another example of capital budgeting. Expansion into new products or markets. Also, you are maybe thinking of starting a new business unit, and you see it as an opportunity and you invest on that. Other projects will be to maybe change your assets because you are seeing a lot of damage on them or loss of value, and you want to rebuy all your, I don't know, trucks or something. And mergers and acquisition, this is actually really interesting. A merger and acquisition, it's when a company buys another company and then they add that operation to their business. And if you are a publicly traded company, if you do a merge, the value of the company doesn't increase double-fold. You know, it's not just the value of the company that is buying plus the value of the bought company. It's actually sometimes it could increase 3, 4, or 5 folds, because mergers actually are expected to generate a lot of cash flow in the future. So that capital budgeting affects. It's a really good. I mean, it's a really interesting analysis to analyze mergers and acquisitions. That's the examples you can have as capital budgeting. When you are analyzing projects as capital budgeting, you will be finding independent projects and mutually exclusive projects. Independent projects are projects that are not affecting between them. You know, they are linked in some way because you are the one who is investing on them. But if you accept one, it doesn't affect the acceptance of the other one, because maybe you have the money or they are not linked to each other. But mutually exclusive projects, that's the other types of projects you may be considering capital budgeting. Those are projects that if you invest in one of the projects, then you cannot invest in the other projects. That will be the two types of projects you have. Independent projects that you can invest on either of the projects and it doesn't affect the other projects, and mutually exclusive projects where if you invest in one, then you cannot invest in the other. Okay. Now, one really important thing when you are seeing or checking capital budgeting is the time value of money. This value of money during time value of money, it's the primary way to value investment in basically all of corporate finance, because as we saw when we were introducing the concept of inflation, money loses its value during time, but it doesn't loses its value only because of inflation. It also loses its value because something called opportunity cost. Okay, so you need to take that into consideration when you are analyzing an investment. Net present value, internal rate of return, modify and incremental internal rate of return, payback period, and well, this doesn't include time value of money, we will see why, and discounted payback period. All of these, 1, 2, 3, 4, 5, and 6 valuation methods include time value of money, because it's a really important part of the analysis for a corporate financial perspective. You need to take that into consideration. Time value of money means that the money you invest in period 1 will be different from the money you have in period 1, 2, 3, 4, in period 4. Okay? So you are expected to generate, what the hell, 5, 4. You are expected to generate higher cash flows in the project compared to the loss of value of the money during time. Okay, so that's a big important thing. Now, just to clarify some concepts, what is the difference between valuation and evaluation? Well, valuation is the process of determining the current or projected worth of assets or an investment project inside a company or investment project. That is, you will evaluate the project. You will see this project's value is this number. Okay, and evaluation is when you have different projects and you say, okay, I am doing this project or I'm doing this project, or maybe inside the same project you are evaluating investments. Okay, so it's really simple. Just have that in mind. Evaluation will be what we will be doing, like technically apply net present value and internal rate of return will be to evaluate the assets and the project. Where evaluation will be when you actually compare the options you have, cash flow generated inside the business case problem for Fernando, and then the decision you will take will part from the evaluation. So if you see it as in order, you first need to evaluate the options, then you need to evaluate them, and then you need to take the decision. What are sunk costs? Well, sunk costs are costs that you cannot include when making future decisions. They are costs that you already spent them. They are outflows of cash and you will not recover them. And it's a really common mistake for analysis to take into consideration sunk cost. I mean, maybe you want to start a new business, but maybe you were inside a business and you already put money in the business and you keep putting money, and then you do an analysis like moving forward, what is going to happen with my cash flows? And then you realize that in order for those cash flows to be complete, you need to keep putting money and more money, and internal rate of return, maybe it's lower than other projects that you have. And you are like, should I change projects or shouldn't I change projects? Because you are thinking of the money you already spent on that company. Well, what you are doing there, the mistake you are making in that case will be analyzing the future cash flow, taking in consideration the sunk cost. That is a cost of a project that you should not take in consideration. It's like from now on, you need to take the cash flow, and the money you need to invest here is the money you will take into consideration. This is also important for your project case scenario, because we will have I want you to think that the investment Fernando did already in the business already generated the cash flow and already saw everything going forward in the business. So Fernando needs to focus on what he's going to be doing now forward, all right? And just take in consideration the future cash flows. Also, you, when you do analysis, try not to take some costs into consideration. Now, some costs are not the same as relevant costs. Relevant costs are the future costs you incur when you take a business decision inside an investment. When you say, I'm gonna do this instead of this, and that increases some of the costs, those costs should be taken into consideration as an investment or increase or on working capital inside the business. So be cautious that you should not confuse some cost and relevant cost. Some costs are costs that already happened and cannot be modified. Relevant costs are costs that will happen when you actually start the decision, or will happen regardless of the decision you take. So those are relevant costs you need to take into consideration. And the last type of cost that you will need to take inside the business analysis for investment and capital budgeting are opportunity costs, because opportunity cost is the foregone benefit that you have when you take a decision. And think about this, and I just told you that time value of money is not only affected by inflation, there is also an opportunity cost. That opportunity cost is actually the rate, the cash flow that you are missing when you take a decision. You have two decisions, right? You can either invest in this or invest on that. When you decide which path to follow, that implies that you are missing the other cash flow. So that's the opportunity cost. So for a good analysis to happen, well, actually the opportunity cost of one investment should be lower than actually the rate, the cash flow generated in the project that you choose, okay? So that's opportunity cost. Of these three types of costs, do you have any question? It's pretty easy to compare, just sunk cost, relevant cost, opportunity cost. Don't take into consideration sunk cost, do take into consideration relevant cost, and when you are analyzing different options, to take in consideration opportunity costs. Okay, so let's move forward. Let's start with the first type of analysis, that is net present value. And why was so important for you guys to build your financial statements? Well, because net present value is calculated from the cash flows, and cash flow comes from the income statement. So if you don't have rightly formulated financial statements, then your cash flow will be wrong. And if your cash flow is wrong, then your net present value will be wrong. And if that is wrong, then your valuation will be wrong. And your evaluation will be wrong, and then the decision that you take will be wrong. That is why it's so important for you guys to understand how the financial statements are related to each other and how are they built. Not for you guys to build them, that's the work for an accountant. It's for you guys to understand, analyze, and then apply different type of time value of money analysis. And this is like, this is time value of money, and I want you guys to remember. Do you guys remember when I showed you the actual versus current value of pesos? You remember that I showed you what is cash flow, what is net present value? Well, if you remember the inflation, when we were talking about inflation, we were seeing that when you have a period, all right, and you have 1, 2, 3, 4 periods, and you have a value, right? Let's say, and that time we use this example, 100 pesos. We say that you have two types of currency to put in your financial statement. You have the actual, and you have the current, all right? And the idea was for you guys to show the effect on inflation. Inflation has on these $100 pesos, I'm sorry, during the time, during the pass of time. So if you were to have a 5% interest, 5% inflation rate, we saw that in period number 1, you have 100 pesos, okay? Because inflation hasn't affected your 100 pesos yet. But for period number 2, you needed to add the 100 to the 100 pesos, you need to add the 5% compound interest here. So you will have 105. All right, and then we say, well, for period number 3, you need to add the 5 pesos again, We also need to add the 5% to the 5 pesos as it is a compound interest. That's how inflation works. And we say that if you if you wanted to do this calculation, you have the value of the money times 1 plus in the inflation rate. And as this is a compound interest, you need to increase it to the power of the period you are working on. That will be 1, okay? And if you go so on, this number will be changed times the period, right? But why does that happen? Well, that was supposed to be a straight line. Okay, let me try it. Well, let's skip that. Okay, you have period number 0, you have period number 1, you have period number 2, 3. You have period number 2, you have period number 3, and of course you have period number 4. Okay? Now, let's put some cash flows here. You have, again, let's put just 100, okay? And let's see how it moves forward. You have 100 pesos here. And if you move 100 pesos to the next one, you will have 100 pesos, which is this one, and you will need to add something. You will need to add 5 pesos, which is inflation, okay? So if you add these two, you have 105, right? This number is this number. Now, for the next one, you need to add the 5%. Well, you need to add the 100 pesos here because this one is moving between periods. Then you need to again add the 5% that the 100 generates as 5% each month, and then a new 5% that this 100 generates here. That will be other 5 pesos. But now you not only have 200s, you also have a 5. So this 5 is also adding value to the next period. So you will have, what is the 5% of 5, guys? Let me take my calculator. So 5% times 0.5, it's 0.25. If you add all this up, you will get 110.25. All right? And now, next period, again, you will have 100, which is the same number. You will have the same number here. And now you will have, again, this number. But now you have 1, 2, 3, 4, 5s, okay? So you need, this one is from this one is from this. You need another one from this, okay? And now you need the 5% of this one, and this one. And to add them here because they are compounding. They are adding each month more value. So this will just get crazy, right? Because we need the 25 cents here, and then another 25 cents here, and then the 5% of this, and you will go on and on. So doing this manually will take a lot of time and a lot of addition. So what you can also see here is that these values are increasing. And if you were happen to do a formula here, and you have the values here, you have the money here, and the time here, and you will, to graph these numbers, you'll find that this will be 100, then 100 and what? 105, then 115, this will be 120 and something, 25, I think. Well, 100 and whatever. What you see here is that these values are actually increasing on what? On an exponential rate, right? So you know that this is exponential. So if it is exponential, it means that these compounding interests are actually power to something. They are power to the period, because each period there is an increase on the value generated. So that's where this formula comes from, because this is an exponential graph. So the formula would be the future value of the money is equal to 1 plus the rate, in this case inflation, times the period, okay? That will be the future value of the money. But we are not interested on the future value of the money. We are interested, our interest is on the present value of the money. Our interest is to take this 105, and convert it into 100. So how do we do that? And I think it was like this. Okay, how do we do that? Well, if you check this, you can see the formula kind of here. You see the 1 plus the rate at the period here, and you are seeing the cash flow here, because what you are doing here is an exercise of discounting cash flows. So let's go back to the board, and the formula we had was future value equals to the value times 1 plus the rate to the time, all right? We want this one, we want the value. So all you need to do, it's a simple algebra exercise. You need to clear this size of the equation. So you go future value equals 1 plus the rate to the period equals B 1 plus the rate to the period over 1 plus the rate. This one is an R, all right? So you will cancel these two and you end up with future value over 1 plus the rate to the T equals to value. And so we don't get confused, we wanna call this present value, okay? So your formula for present value is future value over 1 plus the rate to something, okay? And that something is the period. We are interested on the present value of all the cash flows. So you need to add all the present values of the cash flows, but this one will be 1 because it's the first period, and this one will be 2, right? So how do you put that inside the formula? Well, you need to tell them, well, you need to note in the formula that you need the addition, all right, of all the cash flows from, what is that, time equals 1, from period 1, you know, to the end periods of future cash flow discounted by 1 plus the rate to the power of the period. And that will be the present values of the cash flow, okay? That's the formula we're gonna use to discount cash flows. And in that way, you will have the present value of the cash flows. And that is this formula here, you see? Oh, I'm sorry, it's 0 because, yeah, you have the first period also. Okay, that is the net present value and that is how it works. You guys have a question?
Not right now. Maybe when I'm doing the homework, but not right now.
Okay. Now, if you see something here, we were using inflation to show the information, but actually when you are doing net present value, you need to use a discount rate. Now, one of the secrets, I mean, one of the, well, first you have a lot of elements inside the net present value analysis. One is the cash flow, other one is the statements, the financial statements, and other part of the analysis is the discount rate. What rate are you going to use to discount those cash flows? And remember, you could use inflation, of course, because time value of money is affected by inflation. But again, inflation is only for you guys to see the effect of macroeconomical variables inside the business as microeconomical variables. So it actually doesn't affect decision. No, it does affect decision because of course you are looking for a rate of return bigger than inflation. But when you are doing net present value and analyzing two different projects, what you do need is different rates according to the need of analysis that you have. So these are the three most commonly used discount rates. The first one is the risk-free rate, and then the risk-free rate is actually an opportunity cost rate. It's like if you invest in this project, it means that you cannot invest on the free risk rate available in the market. Cost of capital is related directly to the cost of the money being invested. It's the minimum return you're expecting for the project. And the weighted average cost of capital is the most complete rate you can use to discount cash flow. And it's a combination of rates presented in laws, corporate tax effect, and also historical or expected returns. Those are the three types or discount rates you have to discount cash flows and analyze your net present value. Then let's see each one in detail, right? So you can understand them better. And let's see an example of each one. So the first one is risk-free rate, and an example of this is the CETES rate that you get in Mexico. What that means is that if you had 100,000 pesos to invest in a project, you can either invest on the project or you can buy CETES. And you are guaranteed by the Mexican government that you will get paid the rate you invest on CETES. So you go to the Banco de Mexico and you look for the, well, I actually added this yesterday. So this is the current rate CETES are paying. I mean, it's not bad. It's like 1% greater than inflation, but it's actually a low rate. And the reason why it's a low rate, it's because this is a free risk rate. I mean, you are going to get that money, okay? So that's the risk-free rate. You guys have a question about this one? You can use this one to discount rates. Yes. When? Well, when you only have one project, for example, cash flows, and you don't have anything to compare it to, well, then you compare it to the cash, to the discount, to the risk-free rate on the market. You guys have any questions? No? Okay.
No, profe.
The next one is the cost of capital. The cost of capital is, again, is the minimum expected return on the project. And one example is maybe when you have only credit to invest on the project, that is a bank loan, you have a fixed rate, okay? In this case, it's 14.3%. And you have that rate and you expect the cash flows of the project to generate at least that, because you got a loan and you are investing that money inside the project. So the cost of your capital, because all the money came from investment, I mean from credit, it's the cost of the loan. It's a really easy way to understand it, okay? No questions here, right? Okay.
Nope.
And the next one, it is a bit more complicated one, is the weighted average cost of capital, and that is the WACC. The weighted average cost of capital is a combination of returns and cost of debt discounted by the tax effect on the debt. And this is a formula. It's actually just a weighted average. It's you have a percentage, and then in the percentage you just turn your rates into the percentage and you add them up, and that's actually the WACC. It's pretty easy and straightforward. This is a formula. Is the proportion of equity towards debt plus equity times the cost of the equity plus the proportion of debt over the debt plus equity times the cost of debt minus the tax shield. This is the tax shield. The tax shield is the discount of the rate you have because those interests are deductible from taxes. Let's see an example for it to be more clear. You have these values of debt and equity. You have 100, you have 200, and you have 300. That is the addition of this one plus this one, okay? Now, the weight, it's 33%, 67%, and this up, and you have 100%. What that means? Well, it means that I took the 100 and I divided by 300. I took it, divided by 300, and then I got this result. Okay. Now I have rates, and I have this bank loan. It's 3%, 13%. So I just have to multiply this 33% times this rate, and I have this equity, and I expect to have a 35% return on my equity, on the capital I investing from my savings on this project. So I multiply that here. And before I get this one, I need to add the tax shield. And in Mexico right now, the tax rate for corporate tax is 30%. So my tax shield, or the reduction I have on my interest rate, will be 1 minus 30%. And that actually is 70%. Okay, so that's the number I have here. So I multiply this one times this one, and I get 3%. It's this one times this one times this one. I get 3%, and here I have this one times this one, and here I have 0 because there is no tax shield here. So I have 23%. And my average my average cost of capital will be 26%, and it's this one here. And this will be the rate I will use for my net present value deduction. Okay, let's do an exercise. I'm gonna give you 20 minutes. Yeah, I'm gonna give you 20 minutes for you. This will be the last thing we see today, and next class we will dive into net present value. Please take these values and write it down or take a picture, because I'm gonna. Well, tell me, do you guys want to do this exercise on the main room, or you want to do it on breakout rooms?
I think this one on the main room, so everyone can actually, so I can actually try it by myself.
Okay. So let's do it here. You have this information. You want to open a new business, and you have money that you can get from your brother and sister. That's a loan, and you will have a loan of 100,000 pesos. What is the loan called in accounting? What is the name of a loan loan in accounting?
Liability.
Yep, this will be liability. And also, they are charging you a 30% annual interest rate on 100 pesos, and you also have savings of 600,000 pesos, and you are pulling those savings out of a banknote that was paying you 4% annually. So what is this 4%?
The cost of equity.
The cost of equity, because you were actually earning that 4%, you are expecting at least to have that. So that will be your cost of equity. And what is this 30%, by the way?
30%. That's the
13.
corporate tax.
13%.
13.
13 here, this one.
Cost of debt.
Cost of debt, exactly. And then you have the 30%. And what that is your tax rate for 2020. So what will be the WACC for the business? Well, we will need to, what the hell is my, this is what. Okay, so the first thing we need to do is calculate the weight, all right? So we have a loan of 100,000, and then we have equity of how much? 600,000, all right? So how much is this, guys? I mean, if I'm going to do these exercises on the main room, I expect you guys to help me out.
700,000.
Yeah, 700,000, okay? So if I need the weights of all these two as a function of this total, what actually will be here as weight? I have 100,000 and it's as proportion of the 700,000. Which number do I put here as percentage?
14.28.
To what?
28.
28%. Okay, and here
85.71.
We can actually round this to 3%. Okay. Okay, now we have the weights. Now we need to add the interest, and the rates. And we know the interest, it's how much? How much was the interest? It's 13%. And we have the equity cost at 4%. So this one will be cost of debt, and this one will be cost of equity. Okay? And we have the tax, all right? And the tax is 30%. So what do I need to do now, guys?
Plug it all into the formula?
Exactly. And what was the formula? The formula said that we need to take the cost of this one, which was debt over, no, I'm sorry. It was equity over debt plus equity. That will be this number, right?
Yes.
Actually, it will be this one. Times the cost of equity, which will be this one, plus debt over debt plus equity. That will be this one here. Times cost of debt times the tax shield. And the tax shield is 1 minus the tax. Okay? So, plug it into the formula, right? Here will be 14.3% times what?
0.857, I think.
Times what?
4%.
4%, exactly. And plus 85%, which is this one, times what?
13%.
13%. And this times what? Times the tax shield. And the tax shield is 1 minus 30%. This is 0.7, all right? Or 70%. 70. So how much you get in this? 14% times 4%, what that is?
0.572.
What?
0.572.
7.2. Okay, and this one here.
$11.14.
11.
That's what I said. Yeah.
I have a different number on my answer. 13. Oh yeah, that's because I didn't change that. No, I did this one. So if you multiply 13% times 70%, how much do you get there?
Oh.
13 times 70. Yeah, you get
0.091.
And then and this one multiplied by this one, how much it is?
7.79. 7.8 if you round up.
So this one, why is this like this? 3 times. Okay, yeah, that's correct. So what is the addition of these two on this board?